Welcome back to Senior Smart Money, where we turn complex retirement rules into simple wealth building strategies. I'm your financial advisor, and today we're unlocking two powerful loopholes that can save early retirees thousands in penalty fees while providing crucial income streams. If you're planning to retire before 59 and a half, this video could be worth tens of thousands of dollars to you. The IRS typically charges a brutal 10% penalty on early retirement account withdrawals, but today you're going to discover two legal strategies that completely bypass these penalties. By the end of this video, you'll know exactly how to access your 401k and IRA funds early without giving Uncle Sam a single penny in penalty fees. Let's start with the shocking reality most financial advisors don't properly explain to their clients. The average early retiree who withdraws $50,000 from their 401k at age 55 without knowing these rules pays $5,000 in unnecessary penalties. That's money that should be working for you, not enriching the Treasury Department. But here's the insider knowledge that changes everything. The Rule of 55 is perhaps the most underutilized early retirement strategy in America today. This IRS provision allows you to withdraw money from your current employer's 401k or TSP account without the 10% early withdrawal penalty, but only if you separate from service during or after the year you turn 55. Notice I said current employer. That's the critical detail most people miss. Here's exactly how the Rule of 55 works step by step. First, you must separate from service with your current employer during or after the calendar year in which you turn 55. If you turn 55 in December, you can use this rule immediately. If you turn 55 in January, you have the entire year to separate from service and still qualify. Second, the rule applies only to the 401k or TSP account from the employer you're leaving. You cannot use the Rule of 55 to withdraw penalty-free from old 401k accounts with previous employers, and you cannot use it for traditional or Roth IRA accounts. This is where many people make costly mistakes. Third, while you avoid the 10% penalty, you still owe ordinary income taxes on traditional 401k withdrawals. If you withdraw $40,000 from your 401k using the Rule of 55, and you're in the 22% tax bracket, you'll owe $8,800 in federal taxes plus any state taxes that apply. Here's a real-world example that illustrates the power of this strategy. Susan worked for the same company for 25 years and accumulated $480,000 in her 401k. She decided to retire at 56 and needed $35,000 annually to bridge her expenses until Social Security kicked in. Using the Rule of 55, she withdrew $35,000 from her 401k and paid $7,700 in taxes but zero penalty fees. If she had withdrawn the same amount without knowing about this rule, she would have paid an additional $3,500 in penalty fees every single year. Now let's talk about the even more powerful Rule 72T, also known as Substantially Equal Periodic Payments or SEPP. This strategy allows you to access your IRA or 401k funds at any age without penalties, but it comes with strict requirements that you must follow to the letter. Rule 72T works by requiring you to take substantially equal payments for at least 5 years or until you reach age 59 and a half, whichever period is longer. If you start these payments at age 52, you must continue them until age 59 and a half. If you start at age 57, you must continue them for 5 full years until age 62. The IRS provides 3 calculation methods for determining your annual payment amount. The required minimum distribution method uses IRS life expectancy tables and typically provides the smallest annual payments. The fixed amortization method calculates payments as if you're paying off a loan over your life expectancy, usually resulting in higher annual payments. The fixed annuitization method uses mortality tables and interest rates to determine payments, often producing the highest allowable annual distributions. Let's walk through a concrete example. Robert has $400,000 in his IRA at age 54 and wants to retire early. Using the fixed amortization method with current interest rates and his life expectancy, he can withdraw approximately $18,500 annually without penalty. Over 5 years, that's $92,500 in penalty-free withdrawals that would have otherwise cost him $9,250 in penalties. But here's the critical warning about Rule 72T that could save you from a financial disaster. Once you start substantially equal periodic payments, you cannot modify the payment schedule without triggering penalties on all previous distributions. If Robert needed extra money for an emergency and took an additional $5,000 withdrawal, the IRS would retroactively apply the 10% penalty to all $92,500 he had previously withdrawn penalty-free, plus interest. This inflexibility makes Rule 72T a strategy that requires careful planning and adequate emergency reserves. You should never put yourself in a position where you might need to break the payment schedule due to unexpected expenses or market volatility. Here's where strategic planning becomes crucial. Many successful early retirees use a combination approach, utilizing the Rule of 55 for immediate needs while setting up Rule 72T for longer-term income streams. You might use the Rule of 55 to withdraw from your current employer's 401k for your first few years of retirement, then implement Rule 72T on an IRA for ongoing income. Tax planning becomes especially important when using these strategies. Since all withdrawals from traditional retirement accounts count as ordinary income, you want to manage your total annual income to avoid jumping into higher tax brackets. Many early retirees benefit from spreading withdrawals across multiple years or combining these strategies with Roth conversions during low-income periods. Geographic arbitrage can significantly enhance the effectiveness of these strategies. State income taxes vary dramatically, and some states like Texas, Florida, and Tennessee have no state income tax on retirement distributions. Moving to a tax-friendly state before implementing these strategies can save thousands annually. Let me share another powerful planning technique that most advisors overlook. The bridge strategy involves using taxable investment accounts for your earliest retirement years, then implementing Rule 55 or Rule 72T as those accounts become depleted. This approach allows your retirement accounts to continue growing while you live off investments that have already been taxed. Here's a mistake that costs early retirees thousands of dollars. Many people roll their 401k into an IRA immediately after leaving their employer, not realizing they've just eliminated their ability to use the Rule of 55. If you're planning to retire at 55 or shortly thereafter, keep your 401k intact until you've determined whether you want to use this strategy. Required minimum distributions add another layer of complexity to these strategies. Once you reach age 73, you must begin taking required minimum distributions from traditional retirement accounts regardless of any 72T election you have in place. This coordination requires careful planning to avoid double taxation or missed distribution penalties. Investment allocation within accounts subject to these strategies requires special consideration. Since you'll be taking regular distributions, maintaining appropriate liquidity becomes crucial. You don't want to be forced to sell investments at poor market timing to meet your withdrawal schedule. Professional tax planning becomes essential when implementing these strategies. The interaction between federal taxes, state taxes, and potential future changes in tax law requires ongoing monitoring and adjustment. Many early retirees benefit from working with tax professionals who specialize in retirement distribution strategies. Here's your action plan for implementing these powerful strategies. First, determine your early retirement income needs and evaluate whether Rule of 55, Rule 72T, or a combination approach best serves your situation. Second, model the tax implications of different withdrawal strategies using current and projected future tax rates. Third, ensure you have adequate emergency reserves that won't interfere with any 72T election requirements. Fourth, consider the timing of your separation from service if you want to use the Rule of 55. Sometimes retiring in January versus December can provide significant strategic advantages. Fifth, consult with a qualified tax professional before implementing any of these strategies to ensure compliance with current IRS regulations and optimize your overall tax situation. The Rule of 55 and Rule 72T represent powerful tools for accessing retirement funds early without penalties, but they require careful planning and strict adherence to IRS requirements. Used correctly, these strategies can save you tens of thousands in penalty fees while providing the income streams necessary for successful early retirement. Remember, tax laws and retirement regulations continue evolving, which is why staying informed through channels like Senior Smart Money is crucial for protecting and optimizing your retirement wealth. Make sure you're subscribed and hit the notification bell so you never miss strategies that could save you thousands. Our next video reveals the ultimate early retirement strategy that combines tax-free growth, penalty-free withdrawals, and estate planning benefits all in one account. It's a strategy that most financial advisors don't fully understand, but it could revolutionize your retirement planning. You won't want to miss this game-changing information. What questions do you have about the Rule of 55 or Rule 72T? Share them in the comments below, and I might answer them in our next video. Thanks for watching Senior Smart Money, and I'll see you soon with more strategies to maximize your retirement wealth.